Welcome to this explainer. Today, we're going to completely demystify corporate finance, and we're going to do it by looking through a very specific and honestly really helpful lens. We're going to visualize the modern corporation as a complex machine. Because when you think about it, that's exactly what a business is. It's this highly structured mechanism specifically designed to take in fuel, process it through an engine, and generate a very specific output. By breaking down the anatomy of this machine, we can clearly map exactly how money, value, and power actually flow through the entire global economy.
Okay, let's dive into this. And let's start with the ultimate question. What is a company actually worth? I mean, it sounds like a simple question, right? But the answer to this dictates literally every single decision a financial manager makes. To figure out that true worth, we need to completely unpack the blueprint of our corporate machine, part by part.
So here's our roadmap for today. First, we'll look at the forms of business organization. Second, we'll define the ultimate corporate goal. Third, we'll get into calculating fundamental value. Fourth, we'll see how capital flows. And finally, we'll wrap up with taming financial conflicts. All right, kicking things off with Section 1, Forms of Business Organization, which is basically building the physical shell of our machine.
And this brilliantly illustrates the massive trade-offs you face right out of the gate when setting up a business. Over on the left, we've got the sole proprietorship. It's incredibly easy to set up, you get to keep every penny of the profits, and your business strategy is entirely your own secret. But, and this is a big but, it comes with a glaring vulnerability: unlimited liability. That means your own personal wealth, your house, your savings is on the line if the machine breaks down. Plus, it's notoriously hard to raise outside capital to actually grow. Now on the right, look at the corporation. This is a totally separate legal entity. It gives its owners limited liability, meaning you can only lose what you actually invest, nothing more. It essentially lives forever, and you can raise massive amounts of capital just by selling stock. But the catch? It's expensive to set up, you get hit with double taxation, once on the corporate income and again on your dividends, and you introduce some really tricky governance problems.
Moving right along to Section 2. The ultimate corporate goal. This is where we set the machine's GPS. So, imagine for a second that you're the CEO. What exactly are you trying to achieve every day? Should your number one goal be maximizing customer satisfaction? Or maybe maximizing the sheer size of your firm? Or grabbing the biggest market share? What about relentlessly slashing costs? Or just maximizing pure profit? I mean, these all sound like fantastic things to do, right? But financially speaking, as the single primary objective, every single one of those is actually wrong. Here is the true GPS of the corporate machine: maximizing shareholder wealth. In a well-functioning market where prices actually reflect all the available information out there, maximizing shareholder wealth translates directly into maximizing the fundamental stock price. If you aren't pointing your ship toward that specific destination, you basically have no systematic way to evaluate any of your financial decisions. But wait a second, isn't maximizing profit the exact same thing? If you maximize your earnings per share, aren't you automatically maximizing wealth? Well, not necessarily. Profit maximization is actually a pretty flawed compass because it completely ignores the timing of when that cash actually shows up, and it completely ignores the risk you took to get it. A higher short-term profit might look great today, but if it means taking on catastrophic long-term risks, you're ultimately going to destroy the company's stock price. Okay, Section 3, calculating fundamental value. Let's measure the engine's horsepower. So the crucial point is, how do managers actually pull the levers down in the engine room to get us to that destination? Mechanically speaking, they really only have 3 options to increase fundamental value. First is the amount. They can increase expected cash flows. Bigger is obviously better here. Second is timing. They can speed up that cash flow stream. Money today is worth way more than money tomorrow, so sooner is always better. And third is risk. They can decrease the risk of those cash flows. Less risk directly translates to a higher valuation. And when we talk about those cash flows, we're talking specifically about free cash flows, or FCF. Think of this as the actual tangible output of our corporate engine. It's the real cash that's left over from your sales revenue after you've paid off all your operating costs, handed over your taxes, and made the necessary investments to keep the factory lights on. This is the actual money that is completely free to be distributed back to your investors. But producing that free cash isn't exactly frictionless. Enter the WACC, the weighted average cost of capital. This is the average rate of return that all of a company's investors, meaning both the debt holders and the equity holders, demand to get paid.
You can think of the WACC as the internal friction or the hurdle rate of our entire machine. It's driven by broader interest rates, how risky the firm's operations are, and the mix of debt versus equity the company uses. To create true intrinsic value, the engine's output, those free cash flows, absolutely must overpower this internal friction. All right, on to Section 4, how capital flows. Let's look at pumping the fuel lines. An engine is totally useless without fuel. And in our financial environment, capital is that fuel. If we zoom all the way out to the macro level to see where this fuel actually comes from, we see a really fascinating and maybe a little surprising dynamic. The ultimate net savers, the primary providers of the capital that fuels this whole global system, are just everyday households, literally individuals saving up for retirement or a rainy day. On the flip side, the massive net borrowers, the heavy users of all that capital, are non-financial corporations and governments. Let's actually trace the journey of a single dollar as it flows from a household saver into a corporate borrower. It typically travels through one of three main pipes. First, you have a direct transfer, where a business just sells its securities directly to a saver. Boom, done. Second, you have an indirect transfer through an investment bank. Think of an initial public offering, where the bank acts as a middleman, transferring the securities and taking a fee for the trouble. And third, an indirect transfer through a financial intermediary, like your local commercial bank. In this case, you deposit your paycheck. The bank creates a brand new security, your deposit account, and then it turns around and uses your money to make a commercial loan to a business. Let's move to and see how this builds into the broader financial markets. Here, capital is exchanged for financial securities, which are essentially just pieces of paper, or more accurately today, computer entries, that legally entitle the owner to specific future cash flows. We categorize these securities in a few different ways. On the left side of our grid, you have the market type: money markets for short-term, highly liquid assets, and capital markets for long-term stuff like corporate bonds and common stock. Across the top, you have the type of claim: direct debt and equity, or derivatives, which are financial instruments whose value is entirely based on some other underlying asset. We also really need to distinguish between primary and secondary markets. And it's honestly just like buying a car. The primary market is like buying a brand new car straight off the factory lot. A company issues brand new stock, say in an IPO, and the company itself pockets the cash to fuel its operations. The secondary market, though, is like buying a used car from your neighbor. An existing owner is just selling their shares to another investor. In this case, the company itself is completely uninvolved in the transaction and receives absolutely none of the proceeds. Finally, Section 5, taming financial conflicts. Who is actually steering the ship? Now, what's really interesting about this slide is we have this fully built, perfectly fueled, and finely programmed corporate machine. But at the end of the day, it's still operated by humans. And this introduces a massive vulnerability known as the principal-agent problem. The owners delegate authority to the managers, but as this quote points out, managers are naturally inclined to look out for themselves. Acting in their own best interest might mean gunning for higher salaries, a corporate jet, or a massive corner office, rather than doing the hard work of maximizing shareholder wealth. So to keep managers from accidentally or intentionally crashing the machine, the market relies on specific safety systems, which we call agency costs. First, we tie executive pay directly to the company's stock performance using very careful compensation packages. Make them feel the pain or the gain. Second, major shareholders will absolutely step in and directly intervene if they see their value being squandered. And finally, there's the ultimate market discipline, the constant, looming threat of a hostile corporate takeover if the company underperforms its true potential.
But the conflict isn't just between the managers and the owners. There is a huge amount of friction between the investors themselves, specifically the stockholders versus the bondholders. Think of stockholders as the thrill seekers. They want the company to take on the riskiest moonshot projects because if it pays off, the stockholders get to keep all of that unlimited upside. Bondholders, though, they are incredibly cautious. They only ever receive a fixed interest payment, right? So they get absolutely no extra reward for a massive success, but they bear the total disaster if that risky bet goes bankrupt. To protect themselves from this, bondholders use strict legal contracts called covenants to put heavy constraints on what managers are actually allowed to do. Which brings us to a really fascinating final thought. We've spent this time visualizing the physical structure of a business, the pipes that flow capital, and the mechanics of fundamental value. But when you look at the messy human element, if the managers are naturally just looking out for themselves, and the extremely risk-averse bondholders are constantly fighting with the thrill-seeking stockholders, who is truly in control? Who is really steering the corporate ship? The answer ultimately lies in how effectively a company balances all these powerful conflicting forces through its corporate governance. And understanding how that balance is struck
is the real key to mastering corporate finance. Thanks so much for joining me on this explainer.